Hello, everyone. So this is the first video for chapter 13. And we will discuss investments and the long-term receivables. So in this chapter, we will have a detailed discussion about debt securities and equity securities as an investment. So this chapter will provide some understanding about from the perspective of a founder supplier. Why we need to invest to do investment? Because for two reasons. Number one, we want to make full use of the excess of fund. We want to make money by using money, because when you want to invest something, that means you have excess of spare money, and you want to this spare money make more money for you. It's about profitability. And another factor is some companies want to use investment to add more impacts for some partnership. Strategically, for the future, if you invest more money into a company, if it's larger than 50% of the shares, that means you can make decisions for this company. So the reason is make more money by using the spare money, or have specific or strategic impact with some partnership. Okay, so these two motivations are very important in this chapter when you want to accounting for investments. And you can see this the learning objectives show you different kind of dates, like held to maturity, data security, trading data security, available for sale data security. That's because the motivation for the investment is different, and the accounting treatment will be different. So first, investing for the future. Why we need investment? We have two kind of investment. One is debt. That means it's a financial instrument, represents a creditor relationship, and this relationship will have a interest claim and the principal return claim for this security. It includes treasury security, municipal or corporate bonds. Another one is equity security. It's represents an ownership interest in another company. So usually another one is a portfolio. That means the investments include debt, also equity. It's a mixture of the portfolio. For data security, we will have a few slides, almost 20 slides to show you how to deal with the data security. I highly recommend you to match this content with chapter 14, financing, because chapter 14 will introduce the knowledge about from the from the demander perspective. And some contents are very matured, and you can learn from different perspectives and add your understanding. And for equity security, I highly recommend to match to chapter 15, contribute the capital, to add your understanding from different perspectives. I mean, chapter 15 will introduce the accounting knowledge from the founder, demander as a ownership. I mean, contribute to the capital. So please do that. And okay, so how are investments classified and reported? As we know, as I just introduced, the investments, the motivation of the investments, it's highly related to the economic future, accounting future of this investment. So the accounting technical journalization treatment will be very different from for different categories. So for the debt security, we have held to maturity security. That means the intent of the security is to, it has a positive intent and want to hold until the security maturity. So say you bought a municipal debt bond, and it will be due on December 31st, 2024. And then you bought this and want to hold it until 2024, December 31st, 2024. That's held to maturity security. You know, it's just about your held intent. And the trading security, it means the investor just want to purchase it and sell when he or she can get the profitability, can be profitable, and then they will sell. So the held period will be very different. Well, maybe one day, maybe 10 years. It depends on what is the trading strategy and how many profit he want or she want. And the third one is available for sale security. That's not classified as a held to maturity or trading. That you know, it's the accounting treatment is very similar for trading security and available for sale securities, because the holding intent, the management intent is also similar. Okay, and then the first one, the first equity investment, it's a minority passive investment. The intent of the investment is not to exert significant influence. It's not to want to have significant impacts of the other company. So it's just want to make money by investment. So for example, you buy the stock from Apple, and today's price say it's 400, and if tomorrow it's 500, and then you sell it, maybe you pay. So for this kind of investment, usually only a small part of the the invested companies. It cannot be over 20% of the voting common stock. And then generally, any investment is considered a passive investment when a company owns less than 20%. It's, you know, but if it's the rate is not more than 20%, is maybe it's 10%. But if it has a very big participation in the management team, that's another issue. So the percentage of the voting common stock of the investee is only one criterion for the minority passive investment. But in general, the intent of this investment is to make money. So any change in fair value of the equity investment are reported in net income. Because this kind of investment usually have a very active marketing. So as I would remind you the fair value hierarchy in chapter 4 in the intermediate accounting 1. So there are 3 levels for fair value measurement. Usually the fair value of the equity investment is the first level. So it will have very active marketing, and the fair value change will be reported in net income. And then, so for minority active investments, the first one is minority passive investments. It's less than 20% of the voting common stock. The minority active investment usually is larger than 20% and less than 50%. Usually in this range, the investor will have active impact on the invested company. So if the investment is a minority active investment, and then means the investor has a significant influence of the investing, we will use equity method, not fair value. We will have a detailed discussion in the following slides. What is equity method and how to journalize with the equity method. And the third category of equity investment is majority active investment. That means the investor can control another company. They can control the invested company. So usually the investor owns more than 50% of the voting common stock and control the trustee board and the board of the directors, and can control the business policy or decision making. So in this situation, the accounting treatment will be consolidated financial reports. We will have detailed discussion in the following slides about this. So in general, for data security, we have 3 kind of category. For trading, we use the fair value and reported in the net income. And for available for sale data security, we use the fair value, but we report on the other comprehensive income in the balance sheet. And for held to maturity, we use amortized cost in the balance sheet, and not recognize the unrealized holding gains and the losses. Of course, for the interest, whatever, no matter which category the data security is, we will recognize the interest. You know, as I introduced in the introduction, all of the assets will become expensive when the assets are used by the organization. So this usage lead to the cost of the assets need to be amortized, like the depreciations of the fixed assets and the amortization of the intangible assets. So here, investment is asset. So amortized cost is about to recognize the usage of the investment. So in this case, for the data security, interest is the amortization. We will have detailed discussion about how to journalize this interest, amortize the cost in the following slides. And for equity securities, we have for minority, no significant influence, passive for investment, and the minority active for investment is a significant influence. So the minority passive investment use fair value and unrealized holding gains and losses going to net income, and the dividends, realized gains or losses going to income statement. And if it's a significant influence, it's an equity method. And if it's a control, we need to consolidate the financial reports. And okay, so let's one by one to discuss the 6 kind of securities investment. Okay, so in this case, we have a fair value option. So let's review a fair value hierarchy. You know, in chapter 4, I think last semester you attended this class. Fair value has a 3-level measurement hierarchy. So the GAAP allows companies to report most financial instrument at fair value because it has active market, and the cost of measurement can have some certainties because of the active market. And in this situation, unrealized gains and losses recognized in income in the period in which they occurred. And the fair value option is generally a choice made when a company first purchases a financial asset or incurs a financial liability, and must on an instrument by instrument basis. What does this mean? It means each fair value measurement will use a different measurement protocol. So if you buy stocks from the marketing, because the marketing has a very active fair value, so you will use the marketing price as the fair value. But if you want to buy innovations like a patent, and this patent has no active marketing, you want to use some independent experts, their opinion or their assessment to make sure. But if you decide use one instrument, you cannot change in the following years. So it's an irrevocable decision. And also, the effect of application of the fair value is to make sure the financial assets at the fair value on the balance sheet with unrealized gains and losses recognized in net income. So because the fair value will have a very volatile performance, so we need to separate this kind of unrealized gains and losses from the regular operating income. So the common method is separated from the income statement. We report this kind of unrealized gains and losses in the balance sheet. And it's just because, you know, some research shows the income statement will have more impact for the investors or potential investors. So the GAAP want to avoid this kind of influence to the investor and potential investors. They just recognize this kind of unrealized gains and losses in the balance sheet as a comprehensive income. Okay? So here we say the fair value option allows companies to avoid the earnings volatility that may exist if only one side of their portfolio of financial instruments were reported at a fair value. Okay, so this is the first video. See you next.